Alright, welcome to our Reap Wealth Real Estate Analysis Program software demonstration. Basically what this software is designed to do is to be a tool for the homeowner or the potential homeowner out there, and definitely for investors. And what this is going to do for the potential homeowner is help them analyze whether or not the purchase they're about to make is going to potentially be a good investment down the road, or a bad investment, or maybe just a decent investment. And again, what this also does for the current homeowner is allows them to check out and see whether or not their current home investment is good, bad, or right about in the middle, and possibly what they can do to change that as well. So let's go ahead and get started. Basically, this property information sheet, this is the only input page you'll have to do here. If it's in light blue, you can manipulate it. Let's go ahead and put 123 Main Street. Alright, USA. Okay, now the title of each one of these right here, you can click that and it'll put a best guess in there for you. But if you have a better guess, or as you get better information, you can go ahead and input that yourself and get a better picture. So let's go ahead and put a property in here. 120. Actually, you know what? Let's go ahead and analyze a property that I just completed. Alright. This was the purchase price for the home. I put 3.5% down, and we got a 3.75% mortgage at 30 years. Alright. Okay. Alright, moving down to capital invested again. If you wanted to put just put the capital invested, push the button, you could find out that information. That actually is exactly what we did. We spent well, it was like $950, I believe, just for a cheap wash and dryer to put inside the unit. Generally that makes homes, number one, sell better, and definitely rent better if they have a washer and dryer unit already inside. It's just one slight amenity that it might not raise the price or raise the rent, but it will make your the value a little bit more solid to the potential investor, or sorry, to the potential buyer or the tenant. All of our closing costs were paid by the seller, and weren't quite that high. It was like $3,700. All right, land and taxes. This is exactly what it was. We'll go ahead and leave out the taxes for now, but generally your picture looks better after taxes. Alright, income and inflation. Again, we could press the button here. Alright, our rental income is $1,200 even for this property. The rental increases, now the average is 5.92%, but we're going to go ahead and leave that at 3% and see how they do. Again, property value increases were 12% for the area, and that's over the last 2 years. But we're going to leave it at 5%. Operating expense increases, we'll call it 4.5%, and we'll call inflation 4.5% as well. Now our other investment return. This is basically how well this $6,000 would do in the stock market at 8% compared with our real estate purchase. So we'll get to see how the two match up against each other. And this was a new construction. The vacancy rate for the area is about 4%, but we're going to leave it at 8.32, which is basically 1 month out of the year it's vacant. Our repairs and maintenance are a little bit low because it's new construction, so we'll leave it at $500. Our property management fees are 10%. The area average ranges between 10 and 12%, and nationally that average is between 6 to 12%. You never want to really go below 6, and you don't want to pay more than 12. There's just no reason to. Now, our insurance is $781 for the year, and that's about it. Okay, let's go ahead and hit the continue button and see how our investment stacks up. Alright, this is our simple data sheet And it gives you the 4 ways we make money in real estate: the appreciation, our amortization, all right, or the tenants paying down our mortgage for us, the cash flow, and our deductibility, tax burden or deductibility, and this is basically our depreciation. So we would be able to deduct, if we put taxes in here, we'd be able to deduct $1,300 from our taxes, which is pretty cool. But we did leave that out. So basically, the first year we've got $8,000 in equity, and that's about a little bit more than the $6,000 we put in there. So after the first few months, we're looking pretty good. At the end of the first year, we're looking pretty good. Our cash flow is positive, which we like to see. Now, even if our cash flow was negative, we'd probably still be doing pretty well. Alright, our cash-on-cash return is 12%, which is already beating the stock market, but this is basically the cash we're getting back from the property versus the cash we're putting into the property. And this changes every single year. Generally, you'll see this number get bigger. You can start at 2% on a cash-on-cash return, and it may still be a great investment because you'll see that number just continuously go up. And basically, it goes up with inflation. So as we hit higher and higher numbers with inflation, your investment in this property, or rather our investment in this property, is a little bit better and better. The internal rate of return, think about this as just your overall rate of return or how you compare it to the stock market. So we would be getting 20% versus the stock market getting 8%. So this 20% basically takes into account the cash flow after taxes, our amortization, and our appreciation. So as you can see, year 2, we're basically getting 51% back. This is as if we sold the property at the end of each year, what it would look like if we sold it at the end of one of these years. And it does take into account the appropriate fees that go along with that. However, you would be a little bit silly to sell. You'd always want to take that money out, either in a refinance, which we have down here, which is our cash out or reinvestment option. So if you do a cash out refinance, you basically have to wait, I would say, at least between 8 and 10 years to really see something come out of it. However, on the flip side, if you were to do a 1031 exchange and purchase a new property with the equity buildup that you've had in the property, this is what it would look like. You could, let's say right here, after 9 years, you could buy a property worth $500,000 with the equity buildup that you had in the property. And that's as you can see right over here at this 5-to-1 leverage through a 1031 exchange. Okay, all right. And if we just kept this property for the 30 years, we could cash out. Think about your retirement plan. You spend $6 grand after 30 years. All right. This is our refinance here. So after our 30 years, we could cash out or take out $446,000. Now remember, this is a cash out refinance, so this would be completely tax-free. The government does not tax a loan. All right. We could sell the property at $637,000, or we could just relax and start collecting that $7,293 a year, and just letting that property sit there. All right, and that would be a 27% internal rate of return on our money, or a 114% cash-on-cash return from the cash we put into it. And that's every single year as you go through. All right, and that's basically what the simple data does. The detailed data sheet, same information, just gives you a little bit more of the math behind it, so you can really see how your investment stacks up, and see the math behind that. Your equity chart, I like to think of this as your goals chart, but it just basically says how well your equity is doing. Now remember, we put this at 5%. All right, cash flow. This is how well your cash flow is doing, or your cash flow after taxes specifically, and versus your other investment here. All right, so the blue section here is your equity. So you get all the blue plus the red. You can't kind of see the red here, all right, but you can see the cash flow after taxes there in red. Or you could have put your money in the stock market and basically only got the green portion. All right, you could have only gotten the green portion there. So That'll tell you, and depending on the investment, whether your stuff does better than the stock market or potentially better than the stock market. Now remember, we're only the property value increase. We're saying is only 5% here. So if we were to put in 12, which is the average in this area, and check out our versus other investment, you're looking at $4 million at the end of 30 years. All right, but that's why we're leaving it. We don't want to scare anybody. That's why we're leaving it at 5% there. So I hope you enjoyed this demonstration. Please check out the rest of our information at www.reapwealth.net.